Hi, this is Michael Yardney and welcome to my fortnightly property market update. I've had a great week this week, I hope you have also. It was our wedding anniversary and I woke up in the morning and was given a card by my wife Pam, and in it was a trip for two to Tasmania, and we had a couple of lovely days in Tasmania. And I've just come back and I was looking at the papers and I was fascinated to read a survey commissioned by the Master Builders Association which showed that almost 60% of renters fear they may never own their own home. Now obviously the media's had a field day with this, raising fears about the great Australian dream fading away. As I read on, I came across a line in this survey that brought back some memories. It said the following: the nationwide survey showed that about 51% of parents of adult children are becoming increasingly pessimistic about passing on the great Australian dream to the next generation. Now, I remember hearing that before. It was in the early 90s, during our last big recession, when the media was saying, don't buy properties anymore, they can't go up in value any further. And parents were saying, houses are so expensive, our children will never be able to afford one. Yet, despite all the stories of unaffordability, Australia still has one of the highest rates of home ownership in the world, with about 70% of Australians owning or paying off their homes. And since those gloomy predictions were made, the price of properties has increased 3 or 4 times. Looking back over the years, there's always been plenty of excuses to put off investing in property. I thought today I'd like to look at a few of those excuses, the excuses I could have used in the last 40 years or so, because I've been investing in property for about 37 years. In the mid-1970s, for example, we had a recession, and that would have been a bad time to invest, wouldn't it? Then in the late 1970s, we had rising inflation and an OPEC oil crisis. In 1983, there was a recession with high interest rates and peaking inflation. A few years later, commentators said property prices were too high, they'd never go any further. Now, I clearly remember in 1985 when the government changed the tax laws relating to property, and they quarantined the tax benefits of negative gearing. They sort of cut out negative gearing. They also introduced capital gains tax. And at that stage, commentators explained how this was going to be the end of property investment as we knew it. Then, in 1987, there was a fear of a 1930s type depression after the stock market crash. And then, a few years later, by 1989, 1990, interest rates rose. Inflation was getting high, and it led to the famous recession we had to have. Now, that was, of course, a heaven-sent excuse for procrastinators to stay out of the property market, which was awash with bargains then. Back in 1991, Australian unemployment was 11.3%, and people were selling houses at bargain basement prices, as most people felt property values could only fall further. The mounting foreign debt and current account deficit of 1993 and 94 was enough to scare people off buying property. Interestingly, throughout those times I was buying property. Then there was the world economic slowdown and the Asian currency crisis. They were both great excuses not to buy property in the mid-90s. I remember in the mid-90s we were told that inflation was low, so property prices would stop rising. Then later on, oil prices started rising. Remember September 11th, back in 2001, and there was an oversupply of investment properties in the inner city areas where there'd been a property boom, and that could have been great excuses not to invest in property over the last few years. In 2001, the world had a recession and Australia's economy dropped. We also had the introduction of GST, which was predicted to put a damper on property values. Then a couple of years ago, when interest rates rose, starting in November 2003, for a year or two in 2004, 5, 6, we had a negative press, and at various times, seemingly experienced commentators were suggesting that property values wouldn't increase again until 2010. Then there was further confusion about land tax, vendors tax and interest rate increases. Interestingly, despite all these reasons not to invest in property, throughout these times the value of well-located residential properties has increased consistently, at about 10% per annum. The first investment property I bought for about $18,000 would now be worth well over $800,000 if I wasn't silly enough to have sold it. Yeah, I've made my share of investment mistakes too. I sold my first investment property for a profit of about $3,000, and I thought it was really, really clever. Imagine how much it would be worth if I had kept my property today. And over the years, the rents from my investment properties have helped pay for their mortgages, and the capital growth has allowed me to borrow against them, against this increasing value, to pyramid myself into other property investments. But the purveyors of doom and gloom say, no, things are different this time round. They always say that. But are things really going to be different this time round? In time, we're going to work our way out of this world recession, and eventually each country's economy will turn around and good times will return. And when that happens, the world economy will once again inflate, which means prices will start going up. You see, as the world comes out of this almighty recession that we're experiencing, there's going to be another period of inflation. Some economists are even suggesting hyperinflation. The US government has printed billions and billions of dollars to salvage their economy. So did many other countries. When a government turns on the printing presses and floods the market with more dollars, this eventually leads to a decrease in the value of every dollar, the ones in your pocket and the ones in mine as well. When your dollar buys less and less, the cost of everything is going to go up. This is called inflation. Now, this is good for the government, of course, because they eventually pay back their debts in cheaper dollars, but it's not good for you and me, for the average person. Now, of course, this is a very simplistic explanation, but many economists concur that inflation will come back in a big way. And this is bad news for the average Australian. This will, of course, be bad news for the savers and for the renters. Give it a while, and not only will the price of petrol rise, so will the cost of food and most other things you buy, including properties. Yes, we're going to have another round of inflation, but it doesn't have to be bad news for you. Not if you own the right type of assets, those that increase during periods of inflation, such as well-located residential property. I know debt is a bad word currently, but inflation rewards borrowers who acquire appreciating assets using depreciating dollars. But of course it disadvantages savers as the value of their money goes down over time. So this is going to set the stage for the next significant property boom, as more investors are going to turn back to assets that store value, like residential property, which of course increases in value during inflationary times. Because inflation causes a decrease in value of our dollar, life's going to be much more expensive for all of us in this new financial era. The move back to the inflationary era will catch out those who are not prepared financially. By the way, I've given a step-by-step plan of how to thrive and not just survive in this new financial era in my new book, which only arrived last week, called Thriving, Not Just Surviving in Changing Times. You can find out more about it by clicking the link down below. Now, I'd also like to say thank you to the 400 readers of my e-magazine who bought their own copies of this when I first announced it a fortnight ago. It'll be available in the bookshops in May, but you can get your own copy now by clicking on the link below and you'll have it whisked out to you in the mail. If the financial crisis has taught us anything, it's that we need to take a different approach to money and how we value it, how we procure it, and how we use it. And I explain that in my book, Thriving, Not Just Surviving in Changing Times. So while things are not looking promising for many, the experience can still be turned into a positive one if we become financially fluent and take control of our financial future. You see, there are two worlds out there. During this recession, some people are hurting, and that's terrible. But others are thriving. Also, the gap between the rich and the average Australian is widening. Currently, sophisticated property investors see absolutely amazing opportunities out there, right now, because the field is being cleared for them. There's much less competition and property holding costs are clearly cheaper. They have the confidence to go out and buy the right type of property, one bought well below intrinsic value in an area of proven capital growth and one to which they can add value. These investors are going to thrive in these difficult times, while others are going to have difficulty surviving. By the way, in changing times, like we're experiencing, no one can help you more than the multi-award-winning team of independent property strategists at Metropole. And remember, we help homeowners too, not just property investors. We have no properties to sell, but we have access to every property on the market. So if you want to find out a bit more about what's happening in your local market and what our research suggests in store, join us at a free property briefing in Melbourne, Sydney or Brisbane in our offices. Just click on the link below to find out more and reserve your place. I'll bring you my next property update in a fortnight.